everybody, welcome back to another episode of the Global Fund Voyage, where we help you navigate through the world of investments and market insights. I'm Juliana, and today with me I have my co-host Marcus.
Hi everyone, we're excited to dive into a very interesting topic today which has been gaining a lot of renewed interest. Basically, it's the China A-shares market and how the ongoing market developments are going to shape, how the Chinese equity markets will be moving forward from today.
And then joining us today is Jessica from Lion Global Investors. Maybe Jessica would like to give us a short introduction.
Hi, I'm Jessica from Lion Global Investors. So in LGI, I'm overseeing our investments into the RMB onshore bond market, and I'm also the fund manager for this iFAST-Lion CNH Enhanced Liquidity Fund. So today, I'm very honored to be here to be able to share about the China market.
Thank you, Jessica. And then let's start with the conversation proper. Marcus, over to you first. China A-shares have been gaining interesting attention lately. What do you think is driving this renewed interest, and how do you see it evolving in the near term?
Okay, so over the past few years, the Chinese equity markets have not been performing that well, relative to its peers or the other regions. I think mainly because of these few factors. Firstly, China has a property crisis. China also was facing weak consumer confidence. There was also a little bit of instability, or what we call uncertainty in terms of the business environment. And lastly, there was some geopolitical tensions ongoing. So you put all these four factors together, investors, were unaware or unsure of, how am I going to navigate these kind of, difficult times in the Chinese equity market. So what investors did was monies rotated out into from China into other parts of the world. But recently there was been renewed interest into the Chinese equity markets because the Chinese government has actually rolled out stimulus or targeted stimulus which is aimed to solve the mentioned issues that China was facing. I think firstly, the Chinese government rolled out targeted stimulus which is aimed to solve or help the Chinese property sector as well as consumer demand. So that was the first two main issues that investors wanted the Chinese government to solve. Second thing that gained a lot of renewed interest is actually valuations of Chinese equity markets compared to its peers or compared to its historical averages. Valuations were actually very suppressed. Chinese equity markets were looking very undervalued. So better stimulus compared and coupled that with better cheap and reasonable valuations, that led to a lot of investors actually rotating back into Chinese equities. And then lastly is China is focusing on rebuilding its trust with the business environment. So if for those who have not been following the news, I think recently President Xi actually held a symposium with a lot of business leaders. One of them is actually Jack Ma from Alibaba. So that symposium actually spurred a lot of confidence in investors, as investors finally realized that the Chinese government is actually serious in building back the business confidence, and therefore with all these three factors, Chinese equity markets has been gaining a lot of interest.
Right. Thank you, Marcus. Now, maybe onwards to you, Jessica. We have also seen the People's Bank of China, PBOC, and for short, taking several steps to stabilize the market. How effective do you think these measures will be? And, what impact could they have on investor sentiments?
So to enhance the long-term investment value of A-shares, authorities have to, number one, change investors' perception about the relative value of A-shares, and number two, create conditions that will enhance the earnings of A-share companies. So I want to focus on the second point. So China is facing deflation due to oversupply and insufficient domestic demand, and that's been aggravated by the prolonged property downturn. And as a result, we see that industrial profits are still lackluster. So some traditional manufacturing sectors are seeing profit declines, and there's been overcapacity and weaker global demand. Whereas there's also been other sectors such as property. The developers are still struggling with net losses, and they're also facing debt pressures and weak demand. Hence, we see authorities taking very bold measures to boost overall domestic demand. So one key measure that was announced late last year was the local government debt swap program. While one may think of what has the local government debt swap program got to do with economic growth, so under this program, the expensive debt of local government funding vehicles will be swapped into or refinanced with the longer tenor and lower coupon municipal bonds issued by the local government. So the result of this is that it can alleviate the debt burdens of the local governments and free up fiscal resources for public services and infrastructure projects, hence stimulating broader economic growth and restoring overall confidence. So this complements the government's the other initiative on the property market. So as we know, in September 2024, there was a Politburo meeting, and that called for a policy to stop further decline in the property market. So what we have seen is that mortgage rates have been lowered, home purchase restrictions have been removed in some cities, and at the same time, there's been a lot of efforts to ensure financing goes to the property developers and to the construction projects. So the effect of this is that while existing housing inventory is being cleared, and in time to come, if we have income growth, economic growth, and some degree of urbanization, in over the next few years, we will see that the China property market can progress towards something more healthy, and that is backed by real demand rather than speculative demand. So this will take some time, but at least it is moving in the right direction.
And Jessica, and with that, maybe let me ask you the next question. In the context of the PBOC's recent actions, how do interest rates fit into all of this? What role are they playing in shaping the broader market outlook?
So the PBOC wants to achieve a lower financing cost for the real economy, and to do so, they have to lower interest rates. And lower interest rates also help the banks to maintain a healthy NIM. So NIM refers to net interest rate margins. We need the bank's funding costs to be low as well, because their lending rates would have been lower in order to give their borrowers lower lending rates. NIMs refers to net interest rate margins, and banks need healthy NIMs in order to encourage them to expand their lending. And this healthy NIM, this healthy profits can also help them to cover cost. So this is very important to maintain a healthy banking system. And PBOC needs this in order to make sure that their monetary policy is effectively transmitted into the real economy. And another point is that we all know that historically, China has had very high savings rates. And this savings rates even surged post-pandemic due to economic uncertainty. So having lower saving rates will actually lower the deposit rates, and it will encourage households not to hoard so much deposits, and they can increase their consumption. So this also complements the recent consumption trade-in program, whereby the authorities are giving subsidies to the consumers for them to trade in their old automobiles, household appliances, and this year it's been even expanded to mobile phones for new ones. So in the process of trading in, we see consumption and retail sales actually improve, and this helps to boost the consumption aspect of the economic growth, while exports are taken a beating due to the tariffs.
Thanks, Jessica, for that very detailed explanation. Maybe let's change or shift gears a little bit with whatever's been happening in the market so far. And with all the ongoing volatility in the CNH currency, what strategies can investors consider to actually manage this, volatility and fluctuations in the currency itself?
So while there's ongoing pressure and volatility in the RMB exchange rates due to all these tariff news, investors should also take a step back and note that PBOC manages the RMB exchange rate through a managed floating exchange rate system. So this is against a basket of trade-weighted currencies. This policy achieves a balance between promoting export competitiveness as well as safeguarding financial stability or preventing capital flight. So with this exchange rate policy, the resultant exchange rate movements of the RMB against any single currency may actually be smaller. Two-way volatility is normal, but we often see authorities stepping in when there are larger movements. So in the event of mounting currency pressures, PBOC does have sufficient tools to stabilize the currency. So this includes FX intervention, capital controls, as well as other macroprudential policies.
So Jessica, on that note, how does the iFAST-Lion CNH Enhanced Liquidity Fund fit into the broader picture?
So if the US-China tariff tensions ease, or if China rolls out strong stimulus to offset the tariff impact, the CNH can potentially appreciate. Investors with longer time horizon and who hold this outlook on the Chinese economy can potentially benefit from early exposure into the currency and the A-share market. However, given the low interest rate of both the CNY onshore market as well as the CNH offshore market, we have to recognize that this currency does not offer very high carry. This is because the Chinese authorities had been cutting rates, and this is in contrast to the global central banks who had been hiking rates previously to fight inflation post-pandemic. So the iFAST-Lion CNH Enhanced Liquidity Fund provides a potentially stable yield accrual for investors who want to hold a CNH currency while waiting for the right opportunity to enter the A-share market. At the same time, it provides liquidity with T+0 daily dealing. Now, the interest rate movement of the CNH or the RMB offshore market takes direction from the onshore CNH market. But we have to also note that the offshore CNH interest rates can sometimes be different from the onshore due to liquidity conditions offshore. So currently, we are seeing that the offshore CNH interest rates are much higher than onshore yields. So the yields of the dim sum bond market, so dim sum refers to offshore, are relatively more attractive than onshore yields. So as at end of March 2025, the fund is giving a yield of 2.49%, and the portfolio has an average rating of single A. So we do this by holding a portfolio of CNH dim sum bonds, and that's been issued by issuers diversified across different countries, and they are rated highly. And at the same time, we also maintain liquidity to meet the T+0 settlement. Then this is across holding cash as well as bills.
Right. Thank you, Jessica. Maybe to wrap up, given all that's happening, Marcus, what are the potential long-term opportunities in Chinese equities that investors should watch, especially, in the context of global market trends, and how might these align with themes like urbanization, domestic consumption, as well as global economic shifts?
I think if you really look at what are the opportunities that are in the Chinese equity markets, one of the sectors that we think could potentially take off is actually the tech sector. So if you look at the success of DeepSeek, it has caused a lot of attention to investors, as investors thought that US would be the leader in terms of the AI sector itself, but DeepSeek can kind of cause a little bit of noise in that sector. But after the release of DeepSeek, China is actually looking to capitalize on what DeepSeek has caused in terms of momentum and look to expand on applying DeepSeek's technology into creating intelligent devices and smart manufacturing facilities. But also on the back of it is that there is a lot of trade tensions ongoing. There's also a lot of bans on certain chips that China can gain access to. So China is also looking to build their own self-efficiency in creating open source models, which allows for the easier adoption of AI into businesses in China. So overall, we believe, the recent policy meetings, the development of DeepSeek, is setting the right course for Chinese equities with clear support from the government to solve issues like we have talked about previously, which is the property crisis, weak consumer demand, and also uncertainty in terms of the business environment. And therefore, it's looking pretty promising for the Chinese equity markets, especially the tech sector.
Thank you so much, Jessica, for your insights. And as well, thank you, Marcus, for co-hosting this episode with me. And to all the viewers, thank you for tuning in to this episode of Global Fund Voyage. Until the next episode, take care and happy investing.
Bye.
Bye.